Okay. The new Income Tax Act 2025 is just around the corner, and it's absolutely essential that we get a handle on the changes that are going to directly impact our clients. Today, we're diving into a really crucial chapter, one with some serious compliance implications, Chapter VI, which is all about the aggregation of income. And let's just start with a situation you've probably all seen before.
So, picture this. Your client gets a pretty decent sum of money from a relative overseas. Now, you and I know it might be a totally genuine gift, but to the tax authorities, that could look like a huge red flag. So how do you prove it's legitimate, especially under this tough new framework? Well, this is exactly the kind of puzzle that Chapter VI helps us solve. All right, so here's our game plan for this explainer. We're going to start with the basics of income aggregation under Section 101. Then we'll get into the really critical stuff, the concept of deemed income. We'll do a deep dive into Section 102 with a practical case study, quickly touch on the other related provisions, and then we'll wrap it all up with a handy compliance checklist for your practice. First things first, right? Before we can even begin to talk about tax liability, we have to figure out how the law even calculates the base amount that tax gets levied on. And that's where this whole idea of aggregation comes into play. So Section 101 of the new Act, this is our starting block. It's a lot like its predecessor in the 1961 Act, and it defines total income as, well, the grand total of all income. And this includes amounts that might even be exempt later on. It's a simple but absolutely non-negotiable first step, really the foundation for every single tax computation we do. Okay, so we've talked about what's declared. Now let's shift gears and talk about what might be discovered. This is where Chapter 6 really shows its teeth in the provisions designed to combat tax evasion. And this brings us to the very powerful concept of deemed income. I mean, it's the obvious question from the tax department's point of view, isn't it? What happens when an assessing officer stumbles upon cash or investments or big expenditures that just don't match up with the income that's been declared? Well, the Act has a very specific and very robust answer for that. The law brings in this idea of deemed income. Basically, these are amounts that the law decides to treat as income, even if the assessee never declared them. And it's a powerful tool, covering everything from unexplained credits in the books to mysterious investments, undeclared cash, and even lavish spending that just doesn't make sense with the income you've shown. And you better believe the consequences are severe. Any amount that gets flagged as deemed income isn't just taxed at the normal slab rates. Oh no, it gets hit with a special, much higher, punitive tax rate under Section 195. The government's thinking here is pretty clear. They want to create a huge financial reason not to hide income and make sure that people who evade taxes don't get off easier than those who are honest. So, to see how this all works in the real world, let's zoom in on the provision that gets used most often, Section 102, which handles unexplained credits. Now, for all of you familiar with the old law, you'll recognize this immediately. It's the direct successor to the infamous Section 68 of the 1961 Act. The goal of Section 102 is pretty straightforward. Tax any amount credited in someone's books if they can't give a good explanation for it. But here's the critical part. The law puts the burden of proof, the onus, squarely on the shoulders of the assessee. They have to prove where that money came from. This makes it a really powerful tool, not just for collecting tax, but for fighting things like money laundering too. So look, here's how it plays out. It all starts when the assessing officer, the AO, finds a credit in the books. Then, the ball is immediately in the assessee's court. They have to come up with a full explanation and back it up with evidence. The AO then looks at all of this, and the entire case hangs on one thing. Is the AO satisfied? If not, that money is getting taxed. It's a subjective but very powerful position for the AO to be in.
Let's take a classic example. Say a company gets 10 lakh rupees as share application money, but they can't really prove that the investor is creditworthy or that the transaction is genuine. If the company's explanation just doesn't hold up, the AO has the full power to treat that entire 10 lakh as the company's income for the year. The impact is direct and it's immediate.
And here are the classic traps we need to help our clients avoid. Things like flimsy gift deeds, loans from people with no real financial standing, vague stories that can't be verified, and just basic mismatches in the accounting. In fact, Guidance Note 8 on Section 102 compliance specifically points out that proving the creditworthiness of the lender is just as important as proving their identity. These are the exact red flags that are almost guaranteed to trigger an addition to income. So, we've covered credits in the books with Section 102, but the Act has parallel provisions for other kinds of unexplained assets and even spending. Let's take a quick look at those.
Now, this table is a super handy guide that maps the new sections to the old ones from the 1961 Act. But let's look at the bigger picture. The same logic we applied to Section 102 applies right across the board. So you have Section 103, which goes after investments that aren't in the books. Then there's Section 104 for unexplained cash or valuables. And Section 106 looks at any spending where the source of the money is a total mystery. The principle is exactly the same. If you own it or you spent it and you can't explain it satisfactorily, it's going to be taxed as your income. Simple as that. So now that we have a good grip on the legal side of things, let's switch to the most important part. What do we actually do? What are the key things we need to remember to guide our clients through this? All right, to wrap it all up, here are the key takeaways. If you remember nothing else, remember these 4 things. 1. Chapter V is the absolute starting point for every tax calculation. 2. Sections 102 to 106 are the government's #1 weapon against undisclosed income. 3, and I cannot stress this enough, the burden is always on the taxpayer to prove their case. And 4, failing to do so comes with a heavy price, thanks to the punitive tax rates in Section 195. So here's a practical checklist you can literally start using in your practice tomorrow. First, advise your clients to document everything. In fact, Rule 21 of the new Income Tax Rules 2026 even spells out specific documentation needed for gifts and loans above a certain limit. Second, for any large credit, do your own due diligence on the source. Third, keep the books perfectly reconciled. And finally, preach transparency. It is always better to have a complete explanation ready from the start than to scramble to build one after the tax department sends a query. And that really brings us to the final thought I want to leave you with. This new act just continues the trend towards more scrutiny and more data-driven assessments. So the question we all need to be asking ourselves is this: are our current documentation practices and the advice we're giving strong enough to hold up in this new era? Thank you so much for watching. If you found this explainer helpful, please do like, subscribe, and of course, share it with your colleagues. Just a quick reminder, this video is for educational purposes only and is not professional advice. Tax laws can and do change, so please consult with your professional advisor before taking any action. This is an AI-generated educational video.